All right, so with that, let's jump into today's session. Welcome, everyone. We are 225th session of talking about investing, options, markets, crypto, anything that is related to investing as a retail individual investor, except I don't think I talk about buying and selling homes here, which is a great way to make wealth, something that, I not for me though. I find much better optionality and much better, um, I would say, flexibility in running through the public market. So I don't do too much of a real estate or real estate flipping, etc. So if you have questions around that, uh, I won't be able to answer it, but I'm happy to learn along with you on that one. All right, so let's jump into today's session. So what are we gonna talk about? A quick update on the boot camp. So we're done with our 6 drills, initial 6 drills. Seventh one, I already scheduled it. So this will be important because by now you've already placed some of the trades, right? Starting from drill one as a part of your homework. If you have been sincere enough in doing your homework, some few of you have sent your homework to me, so I know that you have been doing it. But if you've been placing trades, even though it's in a paper trading account, now you're hitting almost, we are 3 weeks away from June 21st expiration date, right? And now this may be a good time to start looking at the trades that have not worked out and figure out how to manage it. So that's why I scheduled the drill number 7 to be managing the trades that might have gone against your thesis. How to reduce the risk on the trade without adding, you putting in additional capital, right? Or without consuming additional buying power. So, and yeah, so that would be useful. Not all trades will go in your favor, right? Even if you get 60-70% success rate, that's great. Now, how about the other 30 or 40%? Shall we just give up, raise our hands and say, okay, I'm done? No, especially when you're trying to sell options, you have a ways to fight back without putting more capital at risk. So that's what we're gonna review in our drill number 7 next Wednesday, as always, 6 p.m. to 8 p.m. All right, let me just switch to different background. Much better. All right, so if you have any questions on the stuff that we covered in our boot camp, put it in the Slack channel if you are already in Slack, or otherwise you can bring it up in this meeting or in our Wednesday's meeting. But if you want to, get some attention in the middle of a week, ping me in a Slack channel. All right, one of the questions, I think, let me see if that person is here or not. Otherwise, I will skip this question. I'll skip it. I think this Balaji had asked, send me an email as a part of our boot camp. He's not here. Okay, so I'll skip this one. The other one was around, I think there was one of your homework was to find out how you can get an information about implied volatility on the tickers in your portfolio, and make sure you have that as a part of your option chain, because it is implied volatility is a big factor in option pricing. As we looked into our last week boot camp, the factors that impact the option pricing. So I think one of you sent me some information on implied volatility. But good thing was he also talked about statistical volatility, which is your actual one, right? But I want to dig one step, deeper into implied volatility. Give an example of why, as an option seller, we have to, uh, you know, We have to understand how IV works and when to take advantage of higher IV when market presents those opportunities. Okay. So I want to give a quick example. I think I also says historical IV. Yes. So statistical volatility or historical IV. So historical implied volatility is what the option pricing it implying it to be, right? What looking at the option pricing, what the volatility that market is expecting the stock to display, right? How much of percent the stock could move based on this option pricing. So it is implied. It may move different one, right? And the actual movement is what called as a historical volatility because now that's history. So if sitting now our current pricing, let's say, let's pick up not Nvidia. Okay, let's pick up, let's say, okay, I'm gonna talk about BlackBerry. So let's pick up BlackBerry. If I'm looking at BlackBerry, the current implied volatility is 99.2%. The expected movement is 63 cents, right? 64 cents. This is what the option pricing is implying that the stock may move. Now, come June 21st, we don't know where the stock would be. Now, once we cross the June 21st, then we will see what the actual movement will be. And then if we back calculate what the IV would have been. So that's what's your historical IV is how much is the implied volatility actually was in the stock. And that's some call it as statistical volatility, some call it as a actual volatility, some call it as a historical IV. They all mean one and the same. So here's an example I want to give you on because this is fresh of the oven, so hot off the press. I tweeted, I think 2 days ago, that today I closed all my covered calls on BlackBerry because if you guys remember, 2 weeks ago, Roaring Kitty was awake, came back on Twitter, and that caused the implied volatility in many of those so-called meme stocks to go through the roof. And I talked about it, saying I'm selling a lot of more covered calls than I will usually sell on BlackBerry to take advantage of it. And I think it was on 23rd or 24th, I closed all of those that I sold to 10 days ago and reduced my cost basis, right? So just to give an example, right? And I know some of you in the boot camp had mentioned that, hey, I don't want to sell options because what if I sell covered call, my stock would get called away. I would rather, what else can you do? You can just wait and pray. So I have owned BlackBerry since 2019. Right? Now it's almost hitting 5th year. My reason of owning BlackBerry was not that's gonna meme stock. I mean, there was no concept of meme stock in 2019. I had a business, I had fundamental reasons to own the stock. With their acquisition of Silence, their focus on the corporate cybersecurity, and then they were building the whole QNX operating system for connected cars and all that. Yeah, and they are moving on that. Business has not been performing as well as I thought it would be. But my holding period, generally, I want to give company, 5 to 10 years to do the work which they have intended to do, right? They were in between talking about separating the IoT and the other division to unlock the value. Then, it didn't happen. So I'm still patient. I can be patient, right? Wait for business to perform. As of now, I've not seen any big reason to say that, okay, I'm done with the stock, I'm done with the management, I'm done with their business plans. So I've not reached at that stage. So there is no reason for me to dump my shares just yet. What can I do? Meanwhile, while I've been holding this stock for 5 years, is to reduce my cost basis. Right? As you reduce your cost basis, the risk in your portfolio continues to go down, right? If you get some stocks for free, you have a zero risk in that stock, right? And then you can be more patient. You can hold through a lot of volatility in the stock market if your own dollars, you have invested $0 in the stock market, right? So I want to give a quick example. These are my all, buys and sell transactions of the stock on BlackBerry, right? First purchase was I got assigned a put at 750, bought more at 474, sold at 789, sold at 829. And in last, I would say 3.5 years, I haven't sold anything. Only thing is, I bought, and this was like I bought at the peak of meme mania, right? So net, my buy price is $5.47, right? Average buy price. So today the stock is trading at whatever, $2.88. So if I just look at my buy price and the stock where it is, I'm sitting at 48% loss. Fair enough, plain simple math. Well, hold on, this is why I love options is I've been selling options for last 4 years or 4.5 years on BlackBerry. Not that I hate business, not that I don't like business, but hey, I want to reduce my cost basis while business take its own time to turn it around. And if it doesn't turn around and my stocks goes to zero, at least I will lose less. So so I pulled out some data. Here's all the transactions that I closed for this year, right? On 1/3, I closed. So sold covered call on 2 contracts, 2 contracts, 2 contracts, 3 contracts, 2 contracts, 2 contracts, 2 contracts. This is the date of opening. And as you can see on 5/14, this is where the meme folks came in, sold a bunch of it, right? Opening covered call, IV is through the roof. And here's the fun part. Opening transaction on 5/14, right? And it is expiring on 24th of May, means 10 days later. Stock is trading at $3.54, and you're selling a $5 worth of call, collecting 46 cents as a premium. 10 days out, you can get 10% of the current stock price if, and at the strike price, which is almost 60% above the current price. Right? So here I'm giving myself a room for stock to run another 60%. And even if it runs another 60%, I'm going to still make 10% plus on it. It's almost like 70% profit if it gets called away. Right? And why I was able to get it, look at this IV, 198, 195, 192. Prior days, the IV wasn't that great. So even if you look at this, I sold it on, let's say, for end of Jan. You have like 45 days out. Stock is 290, and I sold a $3 call, like almost at the money. And I collected only 18 cents. Why the IV was so low? IV was 67. So this is why IV is super, super important if you are dealing in options. Most of the folks will talk about what strike price I want to pick up. But if you don't understand IV and how IV could impact the option pricing, it's difficult to make money, whether buying or whether selling options. If you bought call options or in during meme, you're like paying through your nose because IV is super high. If you're buying leap options right now because the interest rates are super high, those leaps are pretty expensive. So that's why, because we just talked about option pricing and option bootcamp, thought I'll give you this example on how to take advantage when the opportunities presents itself. And look at here, just after the meme mania died down, I opened another covered call. Stock is trading at $3.15. I opened on, it's almost like 4 weeks out. Not enough premium because IVs came down to 94. So I still have 2 trades open in it. One I opened before the meme mania, so and the another one, this one is still open. So what's the benefit of doing it? This year I've collected $500 as a premium. Add up all these. This is a net profit. It'll turn out to be $500. Similarly, 2023, I had collected $412. Right? So overall, over these 1, 2, 3, 4, 5, 6 years, I've collected enough premium, which is like $5 in just selling the option premium. So my current cost basis is 41 cents. So I can really be patient with BlackBerry now. Today, BlackBerry is trading at $2.88. But I've already gotten $5.06 back from what I invested in. So my investment is only 41 cents. So instead of me being 48% down, maybe I could look at I'm 600% up. I think so. One of you had asked me earlier, how can you stay through these big volatility period? It is because if you can continuously reduce the cost basis of owning your shares, it becomes easier. I need one more meme pump or mania so that I can reduce my cost basis to zero. Then I have whatever I invested in, I've recovered everything, and I still hold all my shares. Then I can be patient forever. Right? If it turns around, great. If it not, hey, I'm not going to lose any money because I've taken all my chips off the table anyway. I'm now playing with the house money. So I thought I'll go through this, and there are other examples. It takes time. You're not going to see the impact of it in a year. The stocks where I have them reduce the cost basis by most are the ones which I'm dealing it for 4 or 5 years. But it'll take time. And you need to just keep grinding through it, expiration after expiration. If you look at it, I had like always a 9th, Jan, Feb, March, April, May, June, May. Oh, these are May because I did a lot of Mays because of this meme mania. Now June, and now, I'm going to start putting in July. In 2 weeks later, I'm going to start putting in July covered calls. Keep doing it over and over again. We don't have to try to figure a lot of tickets, just as a process. Pick your deltas and keep doing it. Over the years, you will see the impact of it. Rome wasn't built in a day. Neither this, reducing the cost basis to zero will happen in a day. But if you stick to it, it does. And that's why it works for me. That's what I do it. You may have a different opinion, but I'll share it because it conveys two messages. One is when IV is high, that's where you should scale into positions. So if you look at it, most of the time I'm selling only 2 contracts, 3 contracts, because it's a meme kind of a stock. It could jump 400%, and I don't want to be left out of all the shares, right? So I've been doing only very small portion of overall shares that I hold. But I went big in the May contract because opportunities presented itself in this high IV. So when you have opportunity in high IV, that's the time to scale it. Now I'm going to do only 2 or 3 contracts monthly because the IV is lost. I mean, we don't have that big of an IV. Good. Okay, there are a few questions. Can you remind me what percent IV is considered high? So what I focus on is IV rank, right? And IV rank will tell you where the current IV of a stock is in comparison with the IV in the past. So picking up a nominal IV number does not make sense because let's say if a stock is generally very volatile, like Tesla, like BlackBerry. So for them, 67 IV is not really big because, hey, generally they are more volatile than this 67. But 67 for a utilities company or a consumer staples is considered as high. So the right way to focus on is looking at a IV rank, and that's why I shared that study. You can use that study in your Thinkorswim, and then you can look at XLP is consumer staples. Consumer staples, IV is 12, IV rank is 20, right? So IV rank, anything higher than 40 is what I will start to sell. And IV rank above 60, 70, yeah, that's a great opportunity. Okay. All right, other question. I was assigned sell put of a stock. The price keeps going down past 6 weeks. At what delta should we sell covered call? Like 0.2 or below delta, but the premium is like 10, 15 cents. IVS 45, 47%. Yeah, so I don't know what the stock that you have. If the stock is that doesn't generally moves much, my sweet spot for selling covered calls is between 16 to 20 delta. If I really want, if my intention is just to reduce the cost basis, I really don't want the stock to get called away. And yeah, it might depending on what the stock price is and what the IV is, the premium, you may not fetch much premium, but it's like, yeah, did it once and then I will forget about it. Okay, I think Jay has already responded. Nyanka, didn't you have to pay capital gains on option premium? Yes. So even I have to pay capital gains on some of the stock that I sold. So I'm not talking about post-tax, right? Post-tax, you can save your taxes in many other ways. So every person will have a different situation in terms of how they can save on taxes. So everything is pre-tax. Yeah, you can't get away with tax even if you don't do options. Your covered call price is lower than your buy price. Yes, it is, because I can't control the market. Either I can sit back and say, I'm not going to sell anything covered call at a price which is lower than what I are bought at, and then wait for stock to improve. Look at a BlackBerry, it has not improved. I mean, it's been going down from a stock perspective. But I can be patient because along with that, I've also reduced my cost basis. So now if the stock gets called away, from a tax perspective, I'll have to take a capital loss.
उठो उठो क्या हुआ नींद नहीं हुई क्या रात में
All right, I'm seeing some
नहीं हुई
background
नींद
noise. Let me put on mute. So from stock perspective, it'll be a capital loss, but I know that I've already gotten so much of a premium from BlackBerry, so I don't have to worry much about it. Yeah, I lose money on the stock, but I already, like I said, I already gotten enough on the option side that net cost basis right now is way less. The thoughts on Dell IV, it looks hot. Dell has become hot because of whole AI. But again, I think one of the mistake that rookie option traders do is sell options because you love the IV. Don't do that mistake. First, love the stock. First, build your thesis on the stock that you want to own. When I built my thesis on BlackBerry, it wasn't because of BlackBerry IV is high. Because I looked at it business, I thought that there is some value left in it in terms of cybersecurity. Its brand was strong. And then they were also venturing into IoT and QNX, connected car system. BlackBerry system is used in 200 million cars. And that was my thesis. Then I started looking at now, how do I use options to express my thesis and reduce the cost basis? So make sure your thesis of why you want to own the stock, that is way more important. Even if I'm selling covered calls, not that I'm bearish, because I'm still positive deltas, I'm still bullish. But I want to reduce my cost basis while I wait for business to perform. Or if it doesn't perform, not every business will turn around. Even if you can get 50%, that's like much better hit rate than some of the great investors. But then how do I know that this is whether this will become a WeWork or whether this could become Amazon. We don't know. Amazon had 90% drawdowns in its life. Netflix had that. I'm not saying that BlackBerry could be on Amazon, but you get the point. Right? You got to be patient. You got to watch the business, see every quarter how the business has performed. If I see that the strategy has changed or I don't really like it, that's the time when I will become very aggressive and start selling 30 or 40 delta calls, or maybe just dump the shares at all. So far, I haven't gotten that um, by looking at BlackBerry's quarterly results. So I'll wait. And for me to wait and hold through these ups and downs, option selling helps me. So contrary to general, I think, perception that options is only for short-term traders, my personal experience is options has helped me become a much better long-term investor. If I had not learned how to reduce my cost basis by selling options, I would have gotten out of BlackBerry because I'm sitting at 50% loss. And similarly, like other stocks also, it helps me to go through this volatility and let business take its time. All right, so I thought I'll share this example, especially around a high IV. Scale in when there's a high IV. Is your only argument doing against doing weekly the hassle of monitoring them? If you have time to monitor, is there any real advantage to weekly option selling? So weekly you have the disadvantage is the gamma risk. Like gamma is one of Greeks that we discussed in Wednesday class, which is basically uh, all changes the delta, which is changes the option pricing per dollar movement in the stock. So the gamma value starts to increase as you get closer and closer to expiration. 2 weeks, 3 weeks before expiration, gamma is almost non-existent. A week before expiration, gamma is very much in the party. So a small movement in the stock, because the gamma is high, it will change the delta really high, which means even if a small movement in your stock will cause could cause a higher moment at a movement at a higher velocity in your deltas. So you really have to watch closely. The profitable positions could turn other way around. The amount of risk that you take per unit of a reward is really high in the last week or last week or 2 weeks of option expiry. So that is why I don't want to do it, because look at a per unit risk, reward is not in our favor. So if I have options which are still left out and I have not closed it a week before, and there are a few, like some of the options just don't decay because right now, the volatility has been so high that some of the options just won't decay. But then I know that, okay, these are the 4 or 5 things I need to be aware of. So that's a downside. Plus side is if you do weekly 4, the total premium that you may be able to collect will be more than doing one monthly. Right? So if let's say doing for 21st of June, right? If you're getting 50 cents as a premium, maybe if you do weeklies, you may be able to get 60 cents of a premium. So that will be I would say a plus side. But then each week premium will be, let's say, 20 cents. Right? Now, is it really worth 20 cents for you to go and create a trade and then sell the trade and then monitor it? That you have to figure out for yourself. Surjit say, is there a document of what delta IV rank to sell and what kind of a stocks? So Surjit, I already covered this in the option trading opening checklist. I don't have any book. I've not read any book and learned from any book. I just learned from either watching YouTube, watching Tasty Trade, and then by doing it. So I did talk about it. A trade opening checklist is what delta, how to pick up deltas, how to look at IVs and other stuff. Yeah, there are a bunch of criteria that you need to look at when you're trying to sell an options. All right, so let's get back to the market. Any other questions on options? No, all good. Okay, back to the stock market now. Interesting one, right? Oh man, I don't know why I never did options for years, and because again, I heard from everyone it's too risky. Retail investors should not get in. Oh gosh, how wrong the perception was. But it's never too late to start. So now what? It's almost 8 years, and yeah, now I plan to do it for rest of my as long as I'm investing. Always work with options. All right, let's coming back to the market. Uh, I always said it is hard, if not impossible, to predict the market. But now you see, I want to talk about Mike Wilson, who's Morgan Stanley's chief equity strategist. On March, he says he sees no reason to raise his S&P target. So as we talked about Mike Wilson many times over, I think, last 18 months, 2022, he was a star of the Wall Street because he predicted uh, the the crash of 2022, and he maintained his bearish thesis in 2023, and market was up like 26% in 2023, right? 2024, he still maintained his thesis that the market S&P should be target is 4,500. His target was 4,500 as of March 12th. Today, S&P trading at what, 5,300 or close to that? I don't know where it closed on Friday. SPX 5304. So 2023 didn't really work out for him. 2024, he says, no, I think the market is still overvalued. April became little flexible. In one of the interviews, he said, you got to keep a really flexible, open mind. That's what we do now with the stock picking. He softened his tune a little bit because, the market slide that he had thought will happen in 2023 didn't happen. Market was up 24%. It's like, I mean, it's a humbling business. Right? Market will humble you. So that's why, again, a reason why I don't buy options is if I buy options, I am putting a stake in the ground saying if I buy a call option means stock will go higher. You can't benefit if a stock doesn't move or if a stock goes lower. But if I take the other side of the bet and sell a put, I'm bullish. But even if a stock doesn't move, I'll still make money. If a stock goes down, I'll still make money if it doesn't go down by too much. Market is a humbling business. Always the best three words are like, I could be wrong. I have a bullish thesis, but I may be wrong. So it is a humbling business. Now in May, this week, looks like he's done with his bearish thesis. Now he has raised his target price to 5,400 in 12 months. So now says by June next one, the stock could go up to 5,400. He also wrote that macro outcomes have become increasingly hard to predict in current economic environment, and how the market has been shifting between back and forth between soft landing, no landing, hard landing, and all that stuff. That is, it is impossible to predict on macro, and that's why I've dialed down on talking a lot more about macro. I mean, if folks like Mike Wilson can't predict it, if the Fed can't predict it, those who have like hundreds of PhDs working for them, folks in the Wall Street firms who have tons of resources, like what can you and I do talking and trying to predict where the market will go? So done with predictions of the market. Stay invested as long as you have your right outlook, time period is in the right time period, it's still good. You don't have to, get in and out of based on every analyst prediction on what's happening in the market. So by the way, these are the new predictions. Last week came up. BMO has the highest one, which is at 5,600. Morgan Stanley now from Mike Wilson is like 5,400. And I think JP Morgan, there's only one bear uh, left. I forgot the name, but they were saying now Mike Wilson has turned towards the bullish side. On the street, we have one more bear left, and let's see when that person will turn around. Uh, I don't know whether it's a Deutsche Bank or someone. One analyst, we still have one bear analyst. So yeah, it's impossible to predict. So don't even try it. Don't even try to, don't even look for, ask for a question, where do you think market will go? It's never black or white. It's always shades of gray. I think market will go up, but I'm only 50% probability or 60% probability. What if the other 40% turns out to be true? So we need to construct our portfolio assuming that the other side could be true. Okay. Dave says, what matters what Tom Lee says. 2023 is a Tom Lee's year. Tom Lee was horribly wrong in 2022, but that's what market does, media does, and investors does, right? Anytime, every analyst will have a phase in their life when they will be right, and then we'll put those analysts on pedestal, treat them like a god. We did that with Mike Wilson in 2022. We did that with Kathy Wood in 2021. We did that with Tom Lee in 2023. There will be time. Tom Lee was wrong in 2022. There will be time when he will again be wrong, right? So yeah, we tend to push, as an investor, we tend to put too much importance on one particular year outcome, which is, doesn't really matter in the long term. All right, SPY 1 week performance. This week was all Nvidia's week. All other biggies, if you look at on a weekly basis, didn't do much. Apple was almost nothing. Microsoft, yeah, 2%. Amazon was down 2%. Meta hardly like 1.3%, not big movement. But Nvidia carried the whole market. Majority of the sectors, if you look, I see more reds here than the greens. More shades of reds than the greens. But one big green, Nvidia, was good enough to keep the market weighted index higher for the week. So that's what it is. It's all Nvidia, nothing else.
Overvalued.
Doesn't matter. It's overvalued, overpriced. It doesn't matter, right?
It's
Pricing and the value can
price.
differ, and the difference can stay long. We'll talk about Nvidia, and I'll give you. I'm still saying it's overvalued, but that doesn't mean it's gonna correct it. So you have to figure out what you want to do if you think it is overvalued.
Vivek, it was overvalued 20 years ago when it was at, or 10 years ago, 50, when it was at 70, whatever that is now is probably cents, but it's always expensive, but it's quality. It's very good stock.
Yeah. Now, the question is it worth what it is trading today? So when we look at Nvidia results, we look at those valuation metrics and then you can decide. Sometimes the good companies are never cheap. Right?
Oh, you asked a question, is it hardware or software? It's a platform, but buddy, it's got up to platform status.
Yeah. Yeah, this whole platform word is now being abused by many companies because once you talk about platform, market gives you much better valuation than a single product company. And I think I also tweeted. So since you brought this up, let me bring up that tweet. Uh, any owners of Palo Alto Network? Anyone? I don't own Palo Alto Network. So then you should be interested in this. I think I did mention about, yeah. So this was actually in the earnings deck of Palo Alto Network, right? This slide at the footnote, you'll see platformizations defined as a count of all platformized platforms. A customer platformized on all three platform. Okay. I mean, I'm not kidding. This is like, it's like a tongue twister, right? So I just tweeted about it. I'm like, the word is being abused because Palo Alto, and again, I don't own Palo Alto Networks. The stock has done great. My reading of this is that it is trying to stitch together different solutions to create a platform for cyber or SaaS cybersecurity solution. Palo Alto Network's strength historically has been on the devices, their firewall devices, etc. Again, I'm not from a cybersecurity side. So any one of you, if you work on a cybersecurity, please correct me and maybe educate us, all of us on this. But my understanding is that's how the Palo Alto network started. And then you see these CrowdStrike coming and changing the game, Sentinel-1 coming and changing the game. The other company was started with the name F. I forgot. That got bought over by another company and then it doesn't exist anymore. Both, they were strong on the on-premise firewalls and the hardware kind of a stuff. But when these CrowdStrikes, etc., start to come in, the street started to change their valuation and give more better multiples to the SaaS-based cyber security solutions. That's where when many of these companies start to pivot towards the SaaS based, and it is much easier to build a platform on a SaaS base, right? You could have a different modules. You can start selling more and more modules to customers. You just need to turn on the switch and the module will be on. So I'm seeing Palo Alto Networks trying to catch up with them, especially in terms of multiples. I don't even know what's the multiples for Palo Alto Network. And that's why they started to bring up the story of we're trying to become a platform. But if you look at it, they've done a lot of acquisitions. It's always difficult to change your existing product into a different way of delivery. Now changing from on-prem to SaaS by bringing together a bunch of disparate solutions which you're trying to stitch together. If you build your product natively from scratch for this SaaS delivery, that's much better. That's what, let's say, CrowdStrike, etc., have done. So they're trying to catch up with the CrowdStrike, and then that's why you see a lot of platform word being used in Palo Alto network, right? So let's look at from a multiple perspective. So PANW, what's the multiple that's been according to Palo Alto network, right? 46, PEG is 2.88, price to sales 13. What's CrowdStrike? Price to sales 27, PEG is 32. Market is giving higher multiple to the SaaS-based platform, and CrowdStrike has been built from day one to be a SaaS-based platform, which is now Palo Alto is trying to catch up with. So, yeah, the platformization is an abused word. But when market will give you that multiple, why not use it? That's why every company now use the word AI in their earnings, right? Whether they have anything to do with AI or not. They might be just running the same automation or machine learning workloads that they have been doing for years. But now you can slip in a word called generative AI, and then suddenly some analyst will, up their price target. So that's a trick which has been long followed by companies. So be careful when you talk about platform. Is it really a platform? Is it that they're trying to stitch together? My guess is Palo Alto is trying to become a SaaS-based platform by buying a lot of companies and trying to create a solution. In Nikesh Arora, we trust. Yeah. I mean, he's a great CEO. Bought PNW in 2020. You must have done good. PNW, I mean, the stock has done nicely, nothing, not, no doubt. 2020 till now, where it was in 2020. Let's say, let's go to monthly. So yeah, you've done nicely from almost 180, 150%. The question is, they are trying to, why are they not getting the same multiple is what probably keeping Nikesh awake. And he's trying to figure out how he can have Street give him the same kind of a valuation that Street is willing to accord to other companies. All right. S&P up almost 11% year to date. Nothing to complain about. If you've been stayed invested in the market and did not follow Mike Wilson and got out of the market, congratulations. Markets have been good so far. Doesn't mean it's gonna stay good. That also doesn't mean it's gonna fall. We really don't know what market is gonna do. So stay invested as long as you don't need money to in next 3 years. Who cares where the market goes tomorrow? And if you know how to reduce your cost basis, even better. It helps you to stay. Previous week, the fear and greed index was in the greed. Now, I think it happened only in the last 2 days. We saw market slight weakness, but I guess still FOMO is still there. I think more than $6 trillion is still sitting outside the market in money market funds. And why not? You can still get what, 5.5%. So nothing wrong in sitting in money market fund and waiting for, if you're not comfortable at deploying in the market right now. But again, no one can know where the market will go. So you have to decide what you want to do.
सेल्फ केयर करते, बालते करते, रेस्ट करते, घर सही करते.
Okay.
2 महीने से
All right. I'll have to not change if you. Okay. Now, if you want to speak up, you can please raise your hand and then I'll unmute you because we've been getting some background noise again and again. Asif says it was an eye-opener 2020 how big cybersecurity is when my company logged on entire code base to move to secure network. Yeah, and I don't. So Asif, I think cybersecurity is still going to be a much bigger theme with again with AI, right? And one of we got a hint from a Berkshire Hathaway where they say insurance companies are not that keen to insure cybersecurity, to provide cybersecurity insurance. For insurance companies, they haven't yet figured out how to rightly price the cybersecurity insurance. So they are not going out of their way to sell cybersecurity insurance to companies. So what companies have to do it, because they can't insure, can't get, add up. So basically it's now on to the companies who have to bear that risk. You can't transfer the risk to insurance companies. So then they will invest in buying better and better solutions. So I think cybersecurity is still gonna stay. The bigger question is which player gonna be. So maybe if you're not keen on individual player, the ETF could be the best bet. Can you explain why Vanguard seems to be able to offer more than Schwab in its money market fund yields? Because Vanguard doesn't take too much profits. Without knowing which instruments you're talking about, generally Vanguard may be able to offer because Vanguard doesn't have any pressures to make money. They don't have any pressure. They're not a corporation. They're not what do you call their motive is not a profit-making corporation. They don't exist for shareholders. Vanguard exists for its members. That is why they are able to give the ETF at such a low basis points than the rest of the financial institutions. They don't have any pressure that they need to, generate EPS for their shareholders. So that may be a reason. But Vanguard may be keeping very less fee for itself than, let's say, what Schwab may be keeping. Generally, Vanguard will have a very low price products. Because they don't have to make money. They don't have a pressure to make money. I put it that way. All right. Quick one on the crypto side. FIT 21 was passed by House. 71 Democrats actually voted in favor, which is great. Things are changing. Times are changing. We're getting the other side onto, having them cross to the dark side of crypto world. So, and the biggest news for this week was SEC has approved 19B4 applications for spot Ethereum ETF. We've been talking about this spot crypto ETFs for almost a year. Last June was the first when the spot Bitcoin ETF application was filed. Then we saw Ethereum being filed. And this was in my history of looking at the crypto market, this was the most surprising event for me. No one had expected it. And I want to quickly run through some of the screenshots from some Twitter that how everyone was positively surprised by SEC's decision to approve it. Not that I'm complaining, I won't, but it was like completely surprised out of a blue. No one expected it. And I do join another crypto specific meetup, and we're talking about there has been nothing coming from SEC, and so this will again they're gonna delay, deny it like they have done for Bitcoin ETFs earlier for many times, and that was what the market was expecting. So what happened? Deadline was May 23rd till Sunday, which was last Sunday was what? It was 19th. The applications have been filed for months, and there is a radio silence from SEC. No comment, nothing else till Sunday. Suddenly on Monday, SEC reaches out to issuers asking for some clarifications. And suddenly, everyone got up, and Eric Balchunas, who is a Bloomberg ETF analyst, he was like, now we are changing our odds from ETF approval from 25% to 75%. Because hearing chatter this afternoon, this is like May 20th, SEC could be doing 180 flip on this one, right? And then his subordinate, his teammate tweeted, interns and lawyers will get zero sleep this week because now SEC has suddenly woke up. You got a 2 days to respond to SEC's request, and so that they have all the information that they need to make a decision. Next one, this was a shock. This is the holy shit moment yesterday, even for the people who are inside the process. No one had any idea of that SEC is going to suddenly do complete change in the stance and will approve it. No one expected it. May 21st, Grayscale started filing updates because SEC asked these issuers to change the modification, and all of them are like working overtime whole night to make these changes, remove the staking from there, which was understood. And on May 21st, update, it's happening. There are 5 potential issuers that submitted their amended 9B4s in last 25 minutes. You don't see government agencies working so fast, but this has a lot more to do with the political pressure. Because last 2 weeks of events have probably given a hint to the Democratic, what the powers to be, saying, if we continue to take a stance against crypto faction, that's not going to be good. We're going to hand over the next presidency on a plate to Republicans. That's what we saw. SAB 121 repeal, we saw on 5th, 21 Democrats crossed the aisle and voted in along with the Republicans. And now probably this pressure came from White House to SEC. get your act together and maybe approve it. And then suddenly SEC woke up. BlackRock gave their update on May 22nd, 7 a.m. Remember, it's like an afternoon of May 20th. It's not even 2 days. So many amendments came in. May 23rd, everyone is waiting, biting their fingernails to see when the update will come in. No update. We are still waiting to hear. Not confirmed yet. Another Quentin Tarantino flick. You just can't make this stuff up. And boom, it got approved by 2:08 p.m. This was like a roller coaster ride. And the moment this got approved, 28 minutes after that, VanEck filed their S1. So generally, before your ETF can start to list and trade on exchange, there are two steps. One is 19B4, in which exchanges put on an application saying, hey, we are amending we are changing the rules of what we're going to list. So SEC approved that. It is a different division of SEC which looks at it, which says, yeah, I think we can monitor it. There's enough info available to avoid market manipulation and all that. We allow you to list it. Now, each of the issuers will have to file their S1. Like if you're trying to list a stock, you file your S1. Now, each of the issuer will file an S1. Once S1 gets approved, you'll have those Ethereum ETFs start trading on the exchanges. So VanEck, like in 20, maybe in 20 minutes after approval, VanEck filed their S1. So pretty interesting week. If you are also look into investing opportunities on the crypto side, let's look at where these crypto assets have been doing. And that's the reason why we saw Ethereum move up from $3,000 to almost $3,800 or $3,900 in a matter of 2 days. Because SEC suddenly woke up and industry like, gosh, is they going to approve it? So that's where it is. So ETFs are not yet trading, but I think now it's more of a logistics concern rather than whether SEC will approve or not. Okay, so that's where we are on a crypto side of the house. Ethereum ETF give dividends by staking underlying ETH. No, they cannot. The staking has to be removed because once you add the staking, then that becomes a security. Now, ETH as an asset is considered as a commodity, just like Bitcoin has been. So each of these issuers had to remove the content around that they will be able to stake it and generate some dividend or income from it. You're not going to get that from taking Ethereum ETF. Yeah. Next one is Solana ETF. Oh yeah, now the doors are open. Everyone will try to figure out. But I don't think Solana will happen or not, because in both in Bitcoin as well as on Ethereum, the reason that SEC gave is that we have a well-regulated and a history of mature futures market. So Ethereum futures are been trading on CBOE for 5-6 years. So is the Bitcoin. So there's a lot of history to look at how the spot prices and the future prices are happening. Are there any manipulation that's going around or not? So that's the logic that SEC had used, that we have the futures are well regulated, and hence they approve the futures. So difficult to not approve the spot ones. Solana don't have futures. So I'm not sure whether I'm sure the issuers will file for it, but probably the probability of Solana's or any others getting approved will be much lesser because we don't have a futures for it yet. So anyway, it's down after, who cares? I mean, these assets will move up or down based on, whoever is selling or buying, but the existential risk that SEC could ban, that's gone. So now only thing is the performance risk, and do institutional investors have interest in this or not? Yeah, I'm not recommending anyone to go and buy and all that, but I love to look at this is a completely different, another new part of emerging economy or emerging investing opportunity. And that's what I've been talking about it for now 4 years. A small little exposure is all you need if it works out. And if it doesn't work out, a little exposure is all you would want, right? So position size is more important. So what did I buy or sell? I bought a little bit of Tesla, a little bit of TTD, not a recommendation, but I do want to be transparent in terms of the stocks that I buy or sell because I do talk about stocks. And I sold a little bit of Stone Co. I already gave you my thesis of why this stock is already on my, I don't like it anymore list. After I reviewed its latest annual report, that was a little head scratcher for me. The change in management, the the acquisitions and how the corporate structure is, I'm like, okay, I'm done with this. I still hold it. I have a covered calls on it at a higher delta. If it get called away, let it be called away. I will be happy if it goes away. I have no problem. Okay, any questions? All right, let's move on. Saw Alibaba raising debt, raising $4.5 billion because they want to use it for stock buyback. Again, Alibaba is, when you talk from a valuation perspective, it's a deep value, but you have a huge risk of CCP. And hence, I think that's the reason why it is trading at such a attractive valuation. And Alibaba, I think in the recent earnings call, they also mentioned they're going to go very strong on buybacks. They're going to buy back like almost 7% of a company in 1 year, right? Which is huge. So I saw them raising $4.5 billion. JD.com raised $1.75 billion. Today, all these the stocks of these Chinese companies have been depressed because of all these geopolitical tensions. Right? And then 2-3 months ago, I mean, the theme, I think since the start of the year, the theme among the Wall Street was China is uninvestable. A lot of big institutional investors took money out of China. That's why it was one of the worst performing stock market of the of 2023 Chinese stock market. And hence the valuation so depressed. But if you think that China is not going to engage in a war, and the geopolitical tensions will not blow up the stock market, or China, they'll not basically allow us to invest anymore, or US won't delist, then they are trading at a much cheaper valuation. But the huge risk of this whole geopolitical and the company specific will be CCP, right? You can't put a dollar amount on the CCP risk. So you have to be really careful. I own Alibaba, but now I've already reached, my position size. So I'm not adding any more to it, even though Alibaba, it came down from like 90 plus to now trading at 80. I'm reached my position size. Okay. Alibaba is still going down. I mean, I don't care about what's happening on day-to-day or week-to-week or month-to-month basis. So yeah, it went up high and then went down. Who cares? Yeah. Maybe because Chinese military did their exercises are surrounding Taiwan, right? I saw some news around that. So who knows what the government may be up to? And then if there's a war, then all these stocks will become like what happened with Russia. If you have invested in Yandex, Russian search engine, if you had invested in Ozone, which is Russian e-marketplace, those were great stocks. Or even if you have invested in RSX, which was the ETF, all went down to zero. So there's a huge risk. Saw PayPal trying to monetize, pushing levers on the Venmo, which is increasing the take rate on Venmo and bringing it equivalent to what the PayPal branded checkout is. So which is, again, I like the new CEO. He's ruffling some feathers. He's pushing his team, cutting down the cost. And market has given up PayPal for being dead. So I think earlier someone made a comment, I think PayPal is undervalued. Yeah, that's what I think. PayPal is undervalued. The stock price or the market cap is at the same level where it was 8 years ago. Business is much better than it was 8 years ago. And now we got a completely new almost full new C-suite who are not afraid to make changes. So we'll give it a time. Will it turn around? No one has a crystal ball, but I am willing to be patient. And till then, I'll continue to reduce the cost basis. But it's good to see some moves and trying to make Venmo more profitable and not have Venmo cannibalize its other businesses. So surprisingly, Venmo used to charge 1.9%, whereas your PayPal branded checkout used to charge 2.99%. So you have two businesses charging a different rates, probably going to cannibalize with each other. Now at least they brought down Venmo at par with others. Person to person, it is still free. This is all the merchant charges. What else for today? A new stock that I put on chopping block. StoneCo was the first one. This is a Roblox is the second one. I'll give you my thesis on why I'm departing with the stock. You can derive your own conclusion. Company IPO'd in March 2021. It was at the peak of tech mania, huge tailwind from COVID. Everyone was stuck at home. Kids used to play Roblox. Hit all-time high in December of 141. Post-COVID, business has slowed down. In latest quarterly results, which happened like 2 weeks ago, management guided to lower bookings. That means in the future, there's going to be lower revenue. All that is fine. There are many COVID darlings that are now going through post-COVID, depression in the stock prices as well as business. But what I don't like is expenses are still out of control. 30% of revenue is being given as a stock-based compensation to employees. How about economic austerity, guys? Company has been around for 20 years. And the same CEO is still CEO for 20 years, despite whatever has happened to the stock price. Forget about the stock price. If you're doing your business properly, I'm okay to wait and forgive you, because stock price is governed by whoever comes in the market and says, I'm willing to pay so much, right? But even after 20 years, you haven't been figured out how to operate your business profitably. Okay, that's long enough a time. And the CEO is still there. So it clearly means the board of directors, they're not doing the job or what? So anyway, I decided I'm gonna part away with this stock. Look at its operating income since starting from for last 5 years, every quarter has been negative. Forget about COVID tailwinds and all that. Right? When COVID had its tailwinds, it was less negative, and it's like negative 302 million. And you're like giving 30% of your revenue to management as a stock-based compensation. Clearly, they don't have a shareholders in their minds. And the board of director is not pushing the CEO to think about shareholders. So I have nothing to do with this. I'm like, okay, I'm done. Like this is like some of the stocks wherein the business has not been performing. I was willing to give it more time, but the company has been around for 20 years, which is what's surprising. Anyway, so my average stock price was $116. So far, premium collected was 75. So net cost basis is 41. And I said, I sold a covered call today at 35. Gets called away, I lose $6. Another example. Even if you lose, in this case, I'm going to lose, but I lose less. Because I collected $75 by selling option premium in last 3-4 years, ever since it became IPO. If it doesn't get called away, I'll sell at the money covered call again. So if you own Roblox, you decide for yourself what you want to do. But this is one stuff which I'm like, okay, I'm done. I have another stocks in my portfolio which are down 70%, but management is working and working to reduce the cost to turn around the companies. I don't see that urgency from Roblox. Okay, that's the reason. Any comment on Roblox? I see a comment. I'm staying out of China market, a lot of choice in US market. Yeah. But US market is super, from a valuation perspective, US market is super expensive. I never say no. I only control my position sizing. So I'm not going to go as big in China as I am on, let's say, US market or other market. But yeah, it's a you can take gamble as long as you only put in little amount in the gamble, right? Not through a big chunk. All right, let's look at some money lessons. Quickly run through it. I think this was from one of the podcasts. It says money lesson for kids, but when I went through it, I thought maybe I think this is even for adults as well. So I thought I'll share it in our weekly meeting on some of the money lessons. If you have a kids, maybe discuss with them. If not, discuss with a partner or with yourself. Right? Don't judge based on wealth or poverty. Number one, realize that not all success is due to hard work and not all poverty is due to laziness. So keep that when you're judging someone based on their financial status. A lot more depend on luck than what we give the credit to. As a human being, all the bad things that happen to us is because of luck. All the good things that happen to us is because of me. Right? That's not the case. Which family you're born, which generation you grew up with. Bill Gates became Bill Gates because he went to a school who had a computer. That school had a computer, and that's why he's Bill Gates. If his dad was in a different city, we may not have had Microsoft, right? So a lot of stuff is dependent on circumstances and not really about the person. Second is time is money. The highest dividend that money pays is providing an ability to control your time, be able to do what you want to do, when you want to do, where you want to do, with whom you want to do, as long as you want to do, offers a level of happiness greater than any of the other fancy stuff. The reason why I got personally into this investing, a focus more on it as a full-time is I want to control 4 C's. My calendar, of course, cash, company that I work with, and and the coordinates wherever I want to work with. Right? I can only job that allows me to do this is investing. Support your kids, but don't spoil them. I'm not trying to be mean, but nobody can learn the value of a dollar without experience its scarcity. As a parent, I've been guilty too, right? And that's but human that if the kid is asking for something, we tend to give it to them, which is good, but it's like support them, but don't spoil them, right? Have them learn the value of money. The only way to understand the difference between need and the desire is they'll have to figure out that it needs effort and blood and sweat to earn. So don't hand them on platter. Learning to be frugal without hurting is an essential life skill, and time doesn't stay the same. Today you have good times, tomorrow the things will change, and these life skills will then come in handy. Managing money is a negative art. And I borrowed this negative art from Charlie Munger. He talks about the negative art. Means to build wealth, we really don't have to find out the best Nvidias or the Amazons or pick up a dart and throw it in the center and always hit the bullseyes. We have to make sure that we don't do stupid mistakes that will blow up our account. Even if we invest in ETF, S&P, or let's say broader set of ETFs, I think we will all do good in long term, as long as we don't do stupid mistakes of backing up the truck on SPACs, because everyone was talking about SPACs, or putting my 20% of portfolio in one particular company that has gone up to in last 2 quarters is up 100%. Everyone says is upping their target price. Avoid those blunders, and I think we will all do good. Uh, so managing money or is not about the picking the right stuff in the long term. It is as much as about not blowing up your account. So I think someone else also said, right? Those who don't have money, look at strategies to earn money. Those are money, look at how not to lose money. Right? And long term, how not to lose money, which things to say no to is as important as which stock to pick and invest. I've also learned it hard way. That's why I now become very, very choosy on which stock I want to admit in my portfolio. Right? Other one similar to that is person who makes 50,000 but only needs 40,000 to be happy is richer than a person who makes 150 but need 151,000 to be happy. So it's always relative. Happiness is always relative. Fifth, it's okay to change our mind. Right? For kids as well as for us. I have no shame in admitting that I was wrong on Roblox. And I shared with you guys, now I'm done with it. Company hasn't performing. And I'm changed my mind. I mean, I reserve the right to change my mind tomorrow also. That's why I come and share, okay, this is what I invested in. Tomorrow if I sell it, I'll tell you I sold it. Why? I changed my mind. We have to be flexible. Company doesn't know, stock market doesn't know what I hold in my portfolio. They will do whatever they want to do, right? And if the business doesn't turn around, the management has become, crappy, reserve the right to change mind. As a kid, it's fine to admit that, hey, the major that I chose is not what I'm interested in. Switch. I mean, I've switched careers in my life 3 times. So I can't even tell my kid, hey, this is what you want to major in, stick to it, right? I'm like, dude, I myself have changed my careers. Everything has a price. Busy career, the price is time away from friends, family, and pursuing your hobbies. Stock market returns, the price that you pay for the stock market returns is the uncertainty and volatility. That it's easier said than done going through this volatility. It is stomach churning volatility. We get 20% drawdowns, 30% drawdowns. Steady return from bank deposit. What's the price? Loss of purchasing power. You can get what 0.2% and take zero risk. But the price you are paying is you can't buy the same stuff that you're buying today. You won't be able to afford it because you're losing your purchasing power. So everything that is worth anything has a price. Most of the time, the price is not, there is no label that will tell you what the price is. When you're buying a stock, the management doesn't tell you in their annual report that, we're going to be very volatile. So pick any stock, look at the drawdowns and how much drawdowns that some of the great companies have had. But that's the price of admission in the stock market. That's the price we have to pay if you really want the returns that you can get from the stock market. Otherwise, stick to CDs, stick to T-bills. The price you pay is loss of purchasing power. You have to pick which price you want to pay. Yeah. They are often worth paying, but never ignore that they are true cost. Yeah. Definition of true success. It's not about money. When the people who you want to love you, they do love you. Money won't provide the things that almost everyone wants. No amount of money can compensate for lack of character, genuine empathy towards others. Very, very true. A very big fan of this one. Doesn't matter how much money you have, but if not true to other people, not true to yourself and your family, doesn't really matter. Coming to the stock side of the house, doesn't really matter how great the stock has been. At some point of a time, you feel that if it is not aligning with my value, I'm not going to invest in that stock. I'm not going to invest in directly in any cigarette company. Altria has been a great stock to own. Just that I don't want to invest. Yeah, I probably have exposure to it through S&P 500, fine. But I'm not going to invest in Altria. Always contextualize, don't take on face value. So whatever we talked about, contextualize it in your own life, in your own portfolio, right? For me, I'm okay to hold it for long. You might have a different need. Make sure you define your own long-term, what long-term means for you, and then invest accordingly. It is important that we define the duration of our needs and the duration of our investment should match, whether it is business or whether it is personal life. We became bankrupt because they had a mismatch of durations in their business model. They got into long-term liabilities with short-term assets, short-term income generation by renting out companies, the locations to startups, which will go out of business. They had a mismatch there. As a personal side, if my long-term goal is I need to save for a kid's college, my goal is I need to save for my kids' college in next 2 years and invest in the stock market. That's a huge mismatch. So contextualize this based on what your needs are. That is why I always say, someone asked me about this stock. Is this stock good? Maybe good for me. The stock may not be good for you because I don't know what's the context that you have. So that's why it is very difficult to give anyone a one answer. I know a lot of you want to know that answer, but unfortunately, I can't give you because then I will be just being dishonest or not being, with you if I give us an answer, because I don't know if the stock is good for you or not. It may be good for me. I will let's know what 11:30. Let's jump on to the Nvidia earnings and the stock deep dive. And let's skip the rest of it. Let's go into Nvidia earnings. Any question? See how Japan market is doing. Japan market overall, I think we talked about investing in Japan, right? Last year. After that, it had done good. Now, though, I think right now the concerns on the Japan market is, has the Bank of Japan lost control of its currency? That's the biggest concern. The market over the last 1 year, I think last we covered was in what, April? Not April, what, August or June, July last year. And then I picked up EWJ and then I sold EWJ because I really couldn't bring myself to make it a big position. So it was a starter position, then I sold it. And the market has been on the sideways since then. Anyway, but I think that's a concern that we have with Japan is the debt to GDP ratio is what, up 250%. And some of the movements that we saw and the intervention by Bank of Japan in last, I think it was 3 weeks ago, those are unprecedented. The forex and the currencies don't change or don't exhibit that kind of a volatility. So I think that's a concern. Long term, I don't know, maybe long term, Berkshire is still invested in Japan, but they do it mostly, a lot of their investment is through preferred shares. So they'll continue to get whatever 8%, 9%. I don't know whether the Japanese investment is through the preferred shares or not, but Berkshire is known to do those preferred shares investment. So yeah, I'm not, don't have any EWJ anymore. I think I last sold at about 66 or 67. And yeah, it did good in a year. It was up like 30%, and I couldn't bring myself to take a bigger position. So I'm like, okay, I'm cutting it down. All right, let's talk about Nvidia. Nvidia delivered more of the same plus stock split. Jensen Hua said the S word, but before we get into split, look at the quarterly summary. I mean, it's this 3-digit growth, right? Revenue is up 262%, gross profit up 339%. So it's nothing to complain about. Operating income super high. Operating margin is now 64% operating margin. Right? Unheard of. Net income is up 628% to almost $1.4 billion. Revenue was beat, EPS was beat. It just continues to deliver both on the revenue as well as on the operational efficiency, right? 70% operating margin. So I think earlier Sam was saying that I asked the questions, the hardware or software. One of our analysts on Bloomberg, not Bloomberg's analyst, but some fund manager or some analyst in a fund of a fund manager came on Bloomberg and says it's a great margin profile for a hardware company. 60% operating margin is great for any company, right? Well, that's what got me thinking, is Nvidia really a hardware company? How much is of a revenue of Nvidia is coming from hardware? Because Nvidia doesn't make its own chips. They design the chips that is then made by others. They don't configure the racks. They probably use the third parties to assemble the racks for them. So is it really, or I mean, Nvidia doesn't have a data center, so they're not going to assemble racks, but those who use Nvidia chips probably use other parties to configure the boards and the racks. So I don't know. I couldn't find any information around so-called hardware revenue percentage. But in any case, 65%, even if it is a software company, is a great operating profile for any company. Now it is this quarter. Again, we know that all these past 3-4 quarters has been a huge tailwind from AI. Data center revenue, which is where everyone wants to focus on, was up 427%. You just can't make these numbers up. Only the last time I saw these numbers were with Zoom. Zoom used to post numbers like 300% up, 400% up, because COVID hit, everyone had to use Zoom. Right? And now we're looking at Nvidia, and that's the only big business that's been good. Others are like 18, 40%. But it's all valuation is based on what its data center revenue is doing. And it did $22 billion. And it announced 1:10 stock split. So Nvidia will go down maybe, to less than 200 in a month. If you're waiting to buy Nvidia at a less than $200, you will get an opportunity. No, I'm just kidding, right? It's just a stock split, doesn't change the business. So look at 3-year CAGR. Forget about, just this 1 year. 3-year CAGR, these are some huge numbers. Not gonna go through all of them anyway. But yeah, like $14 billion of cash flow. So it continues to perform on these metrics. And it also raised quarterly cash dividend to 1 cent per share on a post-split basis. So that means it became, 10 cents on current one, and then you split it, it'll become 1 cent per share. CUDA and Tensor will rule. Tensor is from Google. Yeah. So their whole ecosystem of their chips plus the CUDA software. Again, we'll talk about the word platform, and we may have a AI platform in itself, right? Not just the chips, but you get all the associated software along with it. Yeah, that's going to be great. Guidance, they gave a guidance of $28 billion plus or minus 2%, and gross margins of 74%, which It's okay. I've seen better gross margins if you're only a software company. Uh, but yeah, nothing to complain about. I mean, the demand for H200 may very well exceed the supply available. There were some comments from management. A lot of comments are on the sovereign wealth funds deploying billions to take leading AI. And if everyone wants to, become a leader in AI, they will need these chips. One good thing that we found during the call was they were able to at least put some numbers on ROI. I think it was Jensen Wang who said every dollar that these hyperscalers means AWS, Azure, Google Cloud, every dollar that these hyperscalers are spending on Nvidia chips, they can actually get $5 in return in 4 years by renting out as a part of their Google, their cloud offering. They can get actually $5 back in return. So that's a huge ROI. At least we have now start to put some numbers on ROIs. The bigger question is the end businesses who rent compute power from AWS or Google or Azure, will they see uptick in their business by use of AI? That's a big question. Today, I think all companies, they want to invest in AI. I don't think we have seen, except in the customer service area, or in the area of that mostly software, software development, the ROI of investment is still questionable. Or maybe it is too early to determine the ROI. In either case, I don't think we have a proof that the investments that you as a company, let's say Walmart as a company, or Big and Chipotle as a company, if or any of these businesses doing in AI is actually going to pay up. I don't think there's any study or an ROI model built yet, but no one wants to be left behind. So everyone is like, let me take the chips while it is available. Let me, build my AI capacity. Let me hire all the AI researchers to build LLMs and the models and run it through the models, right? Snowflake is doing its own LLMs. Databricks bought in an AI company. Snowflake was almost about to buy a AI company, then they, reverted back. But right now it's an arms race. The question is that gonna give a, a, a big differentiation to make a dent on the business metrics, margin profile? That is yet to be seen. And if end businesses don't think that the AI investments have panned out, then we should see all these stocks correcting. Okay. But until then, enjoy the sunshine. They also announce availability of inference microservices, which is where you can use NVIDIA's, NIMs to generate a response at much faster pace. They also said that Xiaomi has deployed NVIDIA's Drive Orin, which is their software for autonomous cars in their sedan. Again, demand is really, 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 really high. You can see management talking about it. Computing is changing from instructions to intention. I think this was specifically from Jensen Wang. Instead of retrieving pre-coded information, we need to generate responses on the fly, contextual responses. I mean, if you look at recent updates from OpenAI or Google I/O, those are amazing. The question is, are they gonna generate more profits for the companies? That is yet to be seen. There are many, many, many life-changing, business-changing technologies that have happened over the past century, but they have been a terrible, terrible investments. Airlines. The first one that comes to mind is airlines. Can you imagine? They changed the whole way in terms of the how we used to conduct the commerce or business. So such a impactful innovation. but airlines has been the worst investments. So anyway, so a risk for, again, this is mostly my comments. The stock is priced for perfection. Any kinks in the result will cause a damage to the stock price. Number two is comps will become tougher from Q2 onwards, Q2 or Q2 plus, because if you look at the quarter to quarter, quarter one, so in quarter one last year, so Q1 financial year 24, so they talk about financial year. So this is like March 31st, 23. Now we are comparing it with it. And that time we didn't have this whole big AI tailwind, right? So AI tailwind started to kick in from Q2 onwards. So today you are still comparing with the pre-AI tailwind revenue. Now next to move forward, you start comparing with these bigger numbers. So comps will become tougher. So today I can say, they grew whatever 200 plus percent, 262%. Next comp we'll have to see, right? I don't think it's going to grow to 262% because they already guided for $28 billion. From $13 billion to $28 billion is 100% plus. Still a great growth, but much less when you start looking at the comps perspective. Third risk, I feel, is a big concentration risk. Majority of the revenue is coming from hyperscalers and let's say Meta, and they all are looking to design their own chips because these Nvidia chips are super, super expensive. Now, sovereign funds will come in, and how much they will be able to rescue, time will tell, but I feel that's a big concentration risk that they have on the revenue. Stock was up 10% after earnings. It is a new all-time high. Nvidia is closing fast against Apple. So look at where's AAPL. Apple is 2.9 trillion. Nvidia is 2.6 trillion. 300 billion doesn't matter for Nvidia. They'll cover this in a day itself. I think this year, 2024, Nvidia has added $1 trillion to its market cap already. So $300 billion, not a big difference. So my strategy is I'm going to hold my existing portion of shares. As you guys know, I sold some portions already. And this is my, what do you call it, a schmuck insurance. We don't know how long this craziness can continue. So I still want to hold some shares. I think it's still expensive. Talk about valuation. I think it is still expensive because the current price, it requires Nvidia to maintain operating profit of now what is almost 60%, grow their free cash flow at almost 30% year over year for the next 10 years, and all the while protecting its turf from its competition, like AMDs or other vendors who are now getting the same acceleration through the software rather than at a chip level. Right? There are many startups who are working on this. The chips are super expensive. Maybe we can do something at a software layer to accelerate the inference rather than doing everything depending on a faster chips. Right? And then some of the biggest customers could be are turning into its competitors by designing their own chips. So to me, it feels it's overvalued, but I felt the same way a quarter earlier also. And Nvidia so far has proved me wrong. That's fine. PE, forward PE is like 29, and PEG ratio is also more than 2. You decide for yourself. I'm not buying at this stage, but I'm not selling the stake that I still hold in Nvidia. So that's Nvidia earnings review. What your thoughts are? I could still be wrong. I've been wrong on Nvidia, thinking from a valuation perspective, just I can't wrap my head around it. But damn thing continues to grow like 300%. What can you do? And I don't know whether next quarter are they going to grow by 300% or not. So I have to just size my position accordingly. Cool. Any thoughts on Nintendo plans to open a shop in Union Square? Or Samsung pop up gone, Microsoft shop gone? Now Nintendo has been just that because Nintendo doesn't have options in it. I didn't get into it, but this is a stock that I had looked at, I think 2 years ago, NTDOY, if I recall, that's a ticker. But at that time I was bullish. I've not looked at Nintendo recently. I know they made a movie on Mario Kart. At least my kid loved it. But yeah, right now I don't have any feedback on Nintendo as a company. Monetization is a big hurdle. That's a comment. I guess that's about related to AI. They're monetizing the AI. Yeah, right now I feel that getting the benefits out of investments in AI, I don't think any company has yet figured it out. But they don't want to be left behind if their competitors are buying AI chips or getting ahead of investing into AI. They don't want to be left behind. It's an arms race. And Nvidia is the biggest arms dealer, and hence Nvidia is profiting. Okay, so that's on Nvidia. Let's do hims and hers. Before that, if let me sip some water. Any other thoughts? Any other questions? Any other stock? By the way, you can unmute yourself, and if you want to talk through it, go ahead.
My thoughts on Nintendo is do they see an opportunity because San Francisco downtown is really bad.
Yeah, I mean, a lot of businesses have left downtown, so I don't know. Maybe they got some sweet deal. Oh, so FinViz won't even have uh, these tickers, which doesn't trade on exchanges. Yeah, NTDOY.
Samsung's pop-up was in a great place, but they just got rid of it was only occasionally. It's like a billboard. It was right by the Powell Street turnaround, and they just closed it about a few months ago, like in February. I mean, it was only open during special occasions, but it was still a great advertising board.
Oh, God. Yeah, I don't know. All right, let's do stock from scratch, hims and hers. So first thing I'll do is I'll go and look at its latest annual report. So let's go and try to find hims and hers. Investor relations. That's our first page to go to and see if we can find where's the financials. There we go. An annual report, 10K from here. There we go. Let's download this. I'm gonna see. I had a latest financial results, but this is 2023 annual report. Here we go. Let's we're gonna do it together. Let's open its annual report. So first thing first, I want to understand what this company is, what business is it in, to to figure out, to understand and see the business, and then we'll see more into quantitative. First is qualitative, then I look at more into the quantitative information. So I don't want to look at financial result right now, but let's understand first what the business is. Okay. Well, let me get a post-it. Somewhere I had a post-it of looking at the annual report, what sequence I should go through. Okay. So let's go through management discussion of financial results. Okay. So what is HIMSS on Earth? Now I have no idea. I mean, yesterday I just went to investor relations. I downloaded their latest quarterly earnings. And today I'm downloading this. So let's first understand what this company even do. Is a customer first platform transforming the way customers fulfill their health and wellness needs. So it is definitely in the healthcare segment. Mission is to help the world feel great through the power of better health. Help world feel great through the power of better health. Okay. We have a technical platform, distributed provider network, access to clinical capabilities to lead the migration of routine office visits to a digital format. Okay, so they are mostly, so it looks like they have a focused on a telehealth. A platform includes access to highly qualified tech-capable provider network, clinically focused EMR system, digital prescriptions, and cloud-enabled pharmacy fulfillment. So looks like online, you can go online, schedule your appointment with a healthcare provider, and then the healthcare provider can have all your records in their HIMSS and HERS platform. You can get a prescription filled, and they also do the fulfillment, pharmacy fulfillment. So all done through their online platform. They are involved in broad range of conditions related to sexual health, hair loss, dermatology, mental health, and weight loss. Ooh, weight loss, that makes it interesting, given the GLP-1 and all that stuff. HIMSS connect patients to licensed healthcare professionals who can, okay, that's how many of these telemedicine companies operate. Prescriptions are filled through licensed pharmacies on subscription basis. Okay. All right. So I think at least I get some fair idea. Again, not little that what business it is involved in. It's in a telemedicine and has a relationship with the healthcare providers in sexual health, hair, dermatology, mental, and weight loss segments. And then it has got a network of pharmacies who are tied up with them, that once you got a prescription, you want to get your prescription filled, one of those pharmacies will fill up the prescription, and basically you also take a subscription with them. So revenue and key business metrics. Our management monitor two financials: online revenue and wholesale revenue. Okay, what are these two? So they are defined below. What is online revenue? It represents the sale of products on a platform, net of refunds and all that. Okay, that's done on their platform. Wholesale is non-prescription product sale to retailers. So they have some products as well. Did I miss that? In addition, we offer access to health and wellness product designed to meet. Oh, okay. So gosh, sorry, I missed that line. So that's where it means they also have products that they sell to retailers. So it means if I go to a retailer, CVS, etc. Again, I don't know what retailers do they sell into. I can actually buy HIMSS and HERS products over there. So they were okay. So they have a telemedicine, plus they have a products, maybe beauty, wellness products. What it says, yeah, health and wellness products that I can go and buy at a retailer. Okay, so that is called wholesale revenue. Got it. Subscribers are the customers who have one or more subscription and getting billed on a recurring basis on a well-defined, predefined cadence. Okay, so that's your, if you go to HIMSS or HERS, you can have your monthly subscription. And I guess then once you take an appointment, you pay per online visit fee or something. All right. So fine. We figured out how the revenue, what are the two big main sources of revenue? One is online revenue and the other one is wholesale revenue. Clearly, the online revenue is where they have that's the max, the biggest amount. And then the wholesale is pretty small. But this is what, in thousands, or yeah, this is thousands. So $842 million. Okay, and then they have 1 million. Is that it? 1 million subscribers. And yes, if this is in thousands, then it is only 1 million subscribers. Okay, so they do have information. We generated 842 million. This is in wholesale revenue. Subscribers grew to, yeah, it is 1.5 million only. Okay, that's pretty small, I guess. How much other services like a Teladoc, etc. have? So the growth is good. It grew, whatever, 48%, because they started from a smaller base. So it is easier to grow your customer base at a much higher percentage if you're starting from a smaller base. Anyway, we'll come to the financials later. Okay, key factor affecting result of operations, net customer acquisitions. Yes, you need to acquire the customer and then retain them. Investment in growth, expansion into new specialties. We continue to expand into new health and wellness specialties with our offering. Okay. Financials, we'll look at it later. What else do they have? Cost of revenue is a cost directly attributed because they do both. I just want to understand, because the margins on the retail side will be very less, but today that's a smaller portion, so not much worried about that one. Marketing expense, okay, that's all is fine. That numbers, we'll look at it later. It's all numbers. Other income, explanation of the numbers. Where are the risk factors? The other thing we want to look at is contractual obligations. Do they have any obligations which 27 million and 14 million payable next 12 months? Not a big issue. Let me search for any critical audit matter. Nothing, which is good. What I want to look at, off balance sheet arrangements. They do not have any off balance sheet credit exposure to its customers, so which is good, because sometimes some companies may have things that are not reflected in balance sheet, and that should really raise your alarm of why they are doing stuff which is not recorded in these financial statements. Accounting, the other thing is, which came in very handy in case of a WeWork, is related party transactions. Any big related party transactions. Company recorded a total of 4.6, 3.6 to Terminal. Okay, so there's a Terminal Inc., which provides a professional services to the company. So they engage a software vendor to provide a professional services. Maybe this is, and the other company is vouched. Maybe these are related to it, but the amount is not big enough to cause any concern. I would be concerned if these amounts were really, really big. Okay, so that's not a big concern. What else I want to look at before I jump onto financials? I guess that's Secondary transactions. We want to see, is there anything that could raise alarm bells? No. Okay. So now let me go back and start from scratch and see if we can find some more detailed information about growth opportunities. How big is the overall market? We haven't still gotten the market size, right? So there, somewhere they will explain what the total TAM is. Growth opportunities, we talked about this. Let's say TAM, total addressable market. Okay, total addressable market. Come on, they should tell me what's the overall market size. Okay, so not really, I don't know what term they're using, but it's a pretty standard term which will tell you, if I know that this market is only 5 billion and they're already doing 800 million, then not much of a growth remaining in this business, right? If the overall market size is only 5 billion. So knowing a TAM helps us over there. But anyway, I don't think, maybe they are using some other word, but we don't have that information yet. Okay, so we'll come back to this now. At least we got some idea of what the business it is in. There are other companies, similar other companies in this business, like Teladoc. Naresh had mentioned is the Teladoc is there. Then Amwell is there. I think Amwell is also telehealth online. Yeah, hybrid care. So basically telehealth. And then I think Doximity is moving into EMR. Right now, right, it's more on a social networking for medical professionals, but yeah, they could move into EMR also. Okay, so let's now we'll look at their financials. So go back to this. Let's go to the top. Oh, I think I did. Let's go to page number 1. Let's jump over to the consolidated financial statements. Where did it go to financial statements and comprehensive and supplementary data? Okay, so let's look at their start with the balance sheet. $46 million. So before balance sheet, let's see if we can get through operations, P&L statement. 2023. Overall, $872 million in revenue, healthy gross profit, because it's most of the revenue is coming from the telehealth and not from the retail side. So they got a healthy gross profit. Marketing is 446, operations support, technology development, G&A. End of the day, they're not generating any money from running the business, which is fine. Many of the companies that they're starting with don't generate enough of a revenue to compensate, for their expenses. But what surprising me here is 271. So marketing expense is almost 50% of our revenue in 2021. Marketing expense is a little less than 50%, I guess, or 272. divided by 526. Oh, no, it is actually 51% in 2022. Let's look at 2023. Marketing expense is 446 divided by 872 is 51%. So consistently, the marketing sales and marketing expense has been 50% of their revenue. So they are really not getting the traction in the market, at least looking at just last 3 years data. I don't know how long it has been in the business. This should be a history of it when they came out. But anyway, I don't want to spend all the time. I mean, I spend generally more time, but I just want to give you thoughts of how to go around it. So I will look at a history and see, how long this company has been around. But right now we have only 3 years of financial data. So let's get back to their financial statements and back to operations. Okay. So I'm looking at that. This has been consistently 50% of their revenue. Okay. So really, they still have to spend, either it could be through discounting, or have to continue to spend on marketing and advertising to get subscribers. What's happening? Are the subscribers churning? Why do they always have to hunt for a new set of subscribers? I don't know. That information is not there, but fact that it has stayed consistently and not reduced. Good thing is that it has not increased, but the bad thing is it hasn't gone down as well. Right? So you increasing your revenue, spending same amount of kind of money, ending up not really, helping the business in the end. Okay. So yeah, I'll ignore this net income. So that's on their P&L. Total operating expense is $744 million. So let's go back to their balance sheet. So they have cash and cash equivalent of 96 million, short-term investment of 124 million, and their overall expenses is 700 million. So they really don't have much cash available. What am I missing here? Oh, the 110 of goodwill, they must have acquired some companies. Okay. So yes, they will either need to raise cash or they will need to raise debt. Or maybe they would have already, I don't know. We are almost like 5 months into 2024. But looking at this, the balance sheet is not that strong with respect to how much money that they have to spend, right? They only have a cash and short-term investment that maybe they can dump that to convert into cash. It only amounts to whatever, $230 million. And they need almost $700 million. Oh, sorry. My bad. Yes, they need $700 million of X. So they are losing almost $30 million. So I think they can still survive because they're, of course, generating that revenue. So yeah, they can continue to lose money for some time. They still have a cash. So not going to go bankrupt as long as they don't increase their expenses by a lot. All right. So looks at a cash flow. What is the cash flow? One thing I want to look at a cash flow is stock-based compensation. 66 million, which is okay, so 5-6% of their overall revenue. Not too bad. I've seen worse companies like Roblox giving 30% of their revenue as a stock-based compensation. Okay, it's crazy. This is not that bad. And they are able to generate cash, 73 million, but majority of it coming from stock-based compensation. So I'll ignore that. Yeah, so it is positive cash flow, but majority of it came from stock-based compensation. So not too bad, not great as well. Okay. All right, let's now look into and so I did pull up this little longer data to see what other things I see on their quarterly report. Okay, on quarter to quarter, how they have done. So let's see. Okay, so no, the company has been around only since 2019. Okay. Yeah, so revenue has been growing nicely at 40%. So earlier it was growing at 70%, etc., but now it's growing at 40%, which is great. Shares outstanding, not growing a huge amount, which is fine because now they reined in some stock-based compensations. Tries to of course, no earnings, operating margins, barely operating margin this quarter. I think it's been negative operating margin all throughout its history. If I look at its history, it's been negative operating margin all throughout, but now turning around the corner. Revenue has a nice upswing. Stock-based compensation, it's okay. It's not egregious. Finally, some net income, but I'll ignore the net income. Share outstanding have been consistent quarter over quarter. Looking at a free cash flow, if you reduce the stock-based compensation, hardly any free cash flow. A good thing is stock-based compensation is less than 10% of the revenue over many quarters, which I like. So far, so fine. Let's get into do some scoring around it. Mission statement. So this is a rubric I've used, and I pulled it from some of the better investors I see on Twitter and added my own stuff to see what works for me. So now I'm going to grade this stock based on this rubric, and then we'll go from there. This is our first analysis. Quality of mission statement, is this concise? Yeah, their mission statement was to improve the quality of life by health. I think it was a concise. Inspirational, probably. Optionable, I don't know. Does it allow them to go outside the healthcare segment? Probably not. What do you want to award it? 1, 0. You guys play along with me on this one. Freddie, it was your stock. What do you want to award them? 0 or 1 or in between? Okay, I'll go for the middle 1. Okay, so Chandra says give them a 1, but I didn't see any optionable yet. So I'll give 0.5. Does it have a network effect? Network effect to some sort could be if you have more and more providers. I mean, now we're looking at, does this company has a moat or not? The moat can come from a network effect, from a switching cost advantage, intangibles. So I'm going to go through each one of them and see, does this business has a moat or not? Does it have a network effect? Network effect means any new person coming into the joining the company will make it better for everyone else. Kind of, because a new healthcare professional. So healthcare professionals will go where you have a more subscribers. Subscribers will go where you have a more healthcare professionals. You're not going to switch to another social media company because all your friends are on Facebook. So from that perspective, yes, it will have. But currently they have only 1 million subscribers, right? How many subscribers does Teladoc has? Subscribers of Teladoc. 51.5 million. So I guess they are still just building it. I am not comfortable in giving in any numbers for moat yet. Right? If you were the first one in the business, there is no competition, maybe I'll give you something. But guys, we have other providers which much bigger number of subscribers. Switching cost, almost none, right? You can turn off your subscription, go to other healthcare provider. Durable cost advantage. Does it have a cost advantage? I guess no. What do you guys think? My reason of saying no is that they have to pay the healthcare professionals. Basically all they're doing is taking the margins between what they pay to the healthcare professionals and what they get from customers. And the fact that there is no cost advantage is because that's why they are not able to run the business. Operating profits are zero. I mean, they are negative. So I don't think they have any cost advantage. Intangible brand. Now, this is always tricky unless I don't use these products, but I don't know. We've seen hims and hers on their branding power. Generally, you will see the branding power if there is another comparable brand and and this company has got a better gross margins than the comparable brand. I don't know. Maybe we can give a benefit of doubt. More direction. I won't. I mean, if it is expanding, I have a zero. I don't know whether the mode is expanding or not. Doesn't look like it has a big mode anyway. Optionality. Can they expand within this existing industry? I guess they have already demonstrated that they have this. You start with the sexual health, hair loss, dermatology, and then they can move into adjacent areas, right? So I think that is true. Can they expand into any unrelated industries like Amazon, right? Amazon moved into so many unrelated industry. So huge optionality why I'm invested in Amazon. I don't know whether this has got the similar banning or it doesn't even have a balance sheet to move into unrelated industry, but maybe it can expand in its own industry. So I'll give it one. Does it have any counter positioning? Means if its competitor adopt its model, competitor is gonna be worse off. I don't think so. It has got any counter positioning. Okay. I see a comment. Their marketing design of the website is very compelling to buy products for the new customers. Financial health, cash available to survive rough weathers. Not much of a cash. We already seen they hardly have 200 million cash. Long-term debt. Let's look at how much of a long-term debt they have on their balance sheet. It's a cost of revenue. Let's look at the debt. How much total current liabilities, long-term liabilities? Oh, no, they don't have much. So I'll give them one, not much of a gross margin is more than 70%. Give them one. Return on equity is, okay, what's their ROE? Then we should have it. Or this will have it. Return on equity. Let's go to the ratios. Look at ROE. Pretty bad. Negative. So ROE, low average, 0 to minus, it is 0. Operating margin, it is negative. Not even, I mean, 3% in just one quarter. It's aberration, could be aberration. I want them to show consistently operating margin before I start awarding them. Employer rating. How's the employer rating on Glassdoor? Right, let's talk about now we're getting into a little more softer factor. Glassdoor, HIMSS rating. Oh, HIMSS and hers. This is working. I want to get a full, okay. So let's see where it shows up here. What?